calculate mispricing. So after you calculate the price 60.84, compare with the 1 month price is 63. 63 is overpriced. Overpriced is short the future, long the spot. Short the future, long the spot. So you short the 1 month WTI crude oil futures and long the spot. Okay. So once you identify the strategy, okay, long short future, okay, overpriced, right? Overpriced is short future, long the spot. Short the future you put here, long the spot. Okay, because at least one contract is 500 darius. So I put a 500 darius spot. Okay, so how to calculate today's value? Okay, before we calculate this, we have to put this borrow or pay, borrow or lend, and this one is receive or pay storage cost. Okay, so in your SIF or SSF, right? Let's say if this is arbitrage, we follow the arbitrage cost of carrying model. Cost of carrying model from the formula. Okay.
COC is for underlying asset, physical underlying asset, right?
Yes, correct.
Not underlying.
Yeah, you have the underlying also. Okay, because arbitrage you must have one underlying, one futures. Okay, so here, if for your SIF or SSF, right, you follow this one. Okay, follow this one, then you got the dividend. You got risk-free rate, you got dividend. Okay, and for the just now commodity, right, is follow this one, got the storage cost. So that's why risk-free rate and storage cost, they're having the same sign. So means that they are together. If you minus, minus both together. If you plus, you plus both together. Okay, let's look at this. This one. Borrow. Okay, borrow, you need to pay interest, right? Borrow, you need to pay interest because you long the spot. Long the spot means that you have to borrow to buy the spot. So that's why here you minus 126 is because you pay the interest. And when you pay interest, then you know that you need to pay the storage cost also. Okay, because this having the same sign. Okay, but what if you want to calculate the stock index future? Stock index future on single stock futures. So you have RF and D. One is positive, one is negative. So that's why you can see in the payoff for, you can refer back to the tutorial for the arbitrage, right? If you plus the risk-free rate, then you have to minus the dividend. Okay, means that if you lend money, if you short the spot, you lend, and then you earn the interest, but you have to pay the dividend. And then if you long the spot, you borrow money. Long the spot, you borrow money, then you pay interest, then you receive dividend. Okay, so they are having the opposite relation. So remember, when in the exam, right, if you forget about their relationship, refer to the formula, you can know what is the relationship already. So when the relationship is one positive, one negative, then you will know that in your payoff, right, if this one is positive, this one must be negative for stock lah. But this one is different because both also positive. Okay, RF and C is both also positive, so that's why they're having the same sign. They're having the same sign. So that is just showing their relationship. Okay, so after that, you calculate each of them lah. So this one is 63 times 500 is this one. So this is the future price. And this one is spot price 60.5. Using the spot times the 500 darius, then you get this. And then if the market increase 20%, okay, market price is originally is 60.5, increase 20%, will become this one times 1.2 lah, then times 500, so you earn you got this value. Okay, so at the end, which one minus which one? At the end, okay, if we refer to that one, right, October, okay, I need to change something. Okay, so this one, October. Okay, which one minus which one? I haven't put the bracket. Short is beginning minus n. Beginning minus n, so I'll put the bracket here. And then long is n minus beginning, so I'll put the bracket here. Okay, so at the end, you know which one minus which one. Okay, then after that, you sum up together, you get this. Okay, for arbitrage, this one must be positive. The net payoff. The net payoff must be positive. If the net payoff is something other than or not a positive value, then your strategy may be wrong. Then you need to change your strategy. Okay, so this one done. Okay, let's move on to this one. Based on your future position in part A, okay, future position, so just take up this position and then fill in the table below, okay, fill in the table below. So you calculate margin first. Initial margin is 63 times 500 times 25% is 7875, okay, 7875. Then maintenance margin is this level. You use this times 0.65. Okay. Then after that you calculate the adjustment. Okay. So the adjustment is based on your future position is short. Short, you hope the price will fall down. So when the price raise up, you have loss. Price raise up, you have loss. Price fall down, you have profit. Okay. So that is how we calculate this. Okay, so you receive margin call or not? Well, here I think day 3 you receive margin call. Okay, day 3 you receive margin call. Any price level below than 68.51, then you receive margin call. Sorry, above 68.5. So this one we receive margin call. Okay, so this one you just skip through lah. So theory part, just skip through. And this one also I have explained it already. In many past years also we ask you identify explain what is the term of interest rate futures. So you explain out interest rate futures and how this company can hedge the risk. So all the explanation have to be clearly explained. So from your risk exposure, start from your risk. You worry the rate go up or fall down, then how to hedge your risk with the futures. Okay, you can go through with all the answer here. Okay, for this one, raised to 7%, so 100 minus 793. Okay, so your strategy, you worry the interest rate increase, short the future. Short the future at 96, so you can lock at 4%, so the answer must be 4%. So after you calculate, analyze, is 4%. So this one is very easy to confirm the answer. If you do it correctly, you should be able to get back the same percent. So after you get back the same percent, you can confirm your payoff is correct. Okay. So last time we didn't restrict you to have how many percentage changes. You can say change to 7%, 8%, 9%, whatever percentage. Also, you will get back the same answer. Okay, but in the recent past year, we will restrict you to have the same answer as a marking scheme, so that in case you have some error in the middle, right, you still will got the marks for the previous part. Let's say you calculate this correct and calculate this wrongly, so you still got the marks for the first one. Okay, so the difference is 96 minus 93 times 10 contract, because one contract is 1 million, you have 10 million, so 10 contract. So 25 is a multiplier. You can treat it as multiplier for 3-month LIBOR, because this figure is calculated from 1 million times 0.01% times 3 out of 12 months. So at the end you will get 25. Okay, so you can treat it as multiplier as long as the question asks 3-month LIBOR. If the question asks you 6-month LIBOR, this one will be 50. Okay, because the number of days is double already. So this one should be 50.
I'm not sure what's the
100, you can treat it as multiplier also. You can treat it as multiplier because the pricing itself is capture the percentage of of the 1% changes, but this one is 0.01% changes. Okay, so you make it you times 100, you treat it as a multiplier, as a simple words. In a simple words, you just put it as a multiplier. So no matter 6 months or 3 months, you need to times 100. Again, you need to times 100. Okay, so at the end, this one also you can get back the same answer. So rate increase or rate fall down, no issue, the answer will be the same. Okay, it means that you have locked your cost of borrowing to only 100,000. Okay, rate up or rate down, your interest rate cost is only 100,000. Okay, so this one you refer to the coverage. Okay, for this one, web shows option pricing model, substitute everything, find the D1, then after that they want, see what they want a call option, so you just remain as D1 and find normal distribution of D1, 1.24, 1.24. Okay, 1.24 normal distribution table, 1.24, 1.201234, 892, 89251, 89251. Okay, so you get this, and then calculate D2. Okay, using D1 answer, calculate D2. So D2 is 1.03, 1.03, then you find 1.03, 84849, 84849. Then after that you substitute to this, then you get the answer. So fair value is 56. Fair value is 56 cents. So the price is, okay, you got at the 50 cents. So price is under, price are lower than the calculated price. Okay, so compute the profit and loss, so it's the same thing. Calculate the difference. Okay, because you the price raise up, your strategy is long the call. Long the call, price raise up, you earn profit minus your cost. So your actual profit is your net profit is 200,000. And when the price fall down, you lost the premium. Premium is 50,000. Premium is 50 cents times 100 times 10, or you can directly times 1,000 share also can. Okay, based on the above, advise Jennifer on the best strategy to trade the option with appropriate payoff. Okay, Jennifer strategy. Okay. So the management, okay, your friend Jennifer decided to take the opportunity to buy this one, and she would like to seek your advice whether she buy. Okay. So based on the situation, the best strategy is, because here the situation is high volatility, because let's say at announcement, the management announced that they will tender for the project, highway project. So they will get the project or they will not get. If they get the project, share price appreciate a lot. If they cannot get the project, then the pandemic, right, the impact of pandemic will cause the share price to fall down even lower. Okay, so it's high volatility situation. You need to long the call and long the put. Okay, long the call and long the put. So the outcome is avoid the project share price goes up, not secure the project share price fall down. Okay, so you calculate the payoff here, and the payoff level, price level must consist of the the exercise price. $2 is the exercise price. So when the price fall down, when the price raise up, what is happening? So When the price fall down a lot, you earn profit. When the price goes up a lot, you also earn profit. Okay, so based on this, you have to briefly explain why you implement this strategy. Because when they cannot get the project, right, long call will suffer loss. Okay, and then if they're unable to secure the project, but the share price fall down a lot, selling pressure, and your put option will be profitable. Okay, since it's an important catalyst to revive the company, if you have a greater volatility, either up or down, higher volatility, either up or down, so they should use a trader strategy, long the call and long the put. So you don't need to name it like trader strangler. You just need to know what you need to do. Okay, long what, short what, or long both. Okay, so this one is long the call and long the put. Okay, for the question 4. Question 4, okay, this one you transfer this to euro. Okay, so now you see the quotation is different already. Just now is all the currency here is base currency, 1 unit or 100 unit. So now they have different coded currency. So here 250 US dollar transfer to euro, okay, USD to euro. So buy the pound first. After that, buy the euro. Okay, so this one is 4114 and 8638. 4114 and 8638. So we use these two rates. Then this is the base coded currency, right hand side. Coded currency we use DY. And this one is pound, also coded currency we use DY. Okay, then we get the answer. Okay, so this one 100,000 barriers, $60 per barriers, so total is 6 billion US dollar. Then convert first. Okay, how much profit will be paid by Sakura Energy? Okay, Sakura Energy is a Japanese. Okay, they like to import, so they import, so they have to pay in Japanese yen. Okay, so they import, then they pay USD. Okay, so JPY to Euro first. Okay, JPY to Euro, buy Euro. After that, Euro, sell Euro at this, and then okay, I highlight first. Okay, this one. I buy Euro first. After that, sell Euro for pound. After I got pound, sell pound for USD. So see whether is this the same. Same. Okay, we determine which rate to use first. 1, 2, 3. So these 3 rates, is it the same? 1, 2, 3 rate. Okay. Then after that, we determine USD 6 million. USD and pound USD is the coded currency. So divide. So this one divide. Then after that, pound and euro. Pound and euro. Pound also coded divide. Okay. And this one, euro and JPY. Euro is already a base. Then you times. USD. GBP USD. Base is a pound.
No, I mean how come we use base not offer the price? Because I thought it's we convert from USD to pound. That one have to use offer, right?
No, because at the end okay, just now I determine the rates first, right? So how to determine? Now you are the importer, you are from Japan, right? You are the company from Japan. You want to pay your supplier in USD. You want to pay it, but how much JPY you need to prepare? So you need to pay your supplier in USD. So of course your JPY, you want to buy the euro first. Buy the euro. After you get the euro, sell euro for pound. Sell the euro for pound. Base currency, we sell the base currency for pound. After we get the pound, then we sell the pound for USD.
thought it was.
So that is a concept.
Oh, I thought it was US. Oh, okay.
You get it, huh?
I think I thought it was from US. I thought it was from US into yen, not yen to US.
Oh no, because you want to import, you have to pay. Your cash is outflow, not inflow.
Because the question said in JPY, so I think I confused. Like,
How much you need to prepare on it. So no matter how, right? Let's say you want to transfer out your money, you have to prepare the amount in your own currency, and then after that convert.
I wonder why I get confused.
So you have to understand the whole situation, then you can do. Okay, so after that, I think no more lah. This is one of the most difficult questions. Okay, so after that, all theory.